Hello. So I will be discussing this paper by Felipe Alves and Gianluca Violante. So Felipe, I liked your work. So in the paper, they hold like several margins, exogenous, the typical things that referees don't like, you know. And in spite of holding what is exogenous, they get these rich dynamics, and I found it was a very interesting work. Okay, so I tried to. I'm sorry about the kind of the heavy slide. I wanted it to fit in only one, you know. But basically, what they do, you've seen. So they investigate the implications of several Taylor rules, and they have this Okun hypothesis as a benchmark. Basically, they are asking whether monetary easing, if I can call it this way, can improve labor market condition of the poorer workers through better upward mobility. Okay, and so they compare three types of rules: inflation targeting, average inflation targeting, and then at the end they show that this asymmetric rule that is more aggressive in a recession can actually improve the situation of the poorer workers. So they rely on three empirical facts. Oops. The first one is that poorer workers are more exposed to aggregate fluctuations. So in a recession, they would be hurt a lot as compared to richer workers. Also, when you lose your job, you may suffer long-term productivity losses. Okay, so this is not nice for them, you know. And finally, poor workers are more likely to leave the labor force. Okay. So as I said, they keep several transition probabilities, or rates in this case, because it's a continuous time model, exogenous. But the model allows for endogenous participation decision, and also they have like the monetary part where the monetary policy can affect employment. No? So, and they show that basically a recession may affect primarily marginal workers at the bottom of distribution. They would lose human capital, and they would suffer these persistent effects. Through monetary policy easing, this would improve the labor market condition. And in the end, they conclude that the asymmetric Taylor rule would be like the most friendly from this perspective. Okay, so that's the paper in a nutshell. Okay, so I said the paper like keeps some margins exogenous, which are typically endogenous in like I would say textbook search and matching model. I'm thinking about the job creation condition. In their model, it's like there is a priority to move between employment states, but it is held exogenous. And also they have this assumption about wages. So what I want to do here is to basically convince the potential referee, if I could say, that actually in the end, if you could make these things endogenous, you will likely get the same type of mechanism in the model. Okay? So for instance, one assumption they have is that they have this union that set wages for all employed workers. They do it in a way to improve their welfare. And on the other hand, original search and matching models consider large bargaining. So clearly, this assumption is made for practicability. You know, if you, given this union thing, agents can take wages as given, which is a lot like the resolution of the model. Otherwise, when you have bargaining, so it's well known, you may have like wages depend on the asset position of the workers. It's not very nice to work with this element. Has been shown in this paper by Croissant and co-authors. On the other hand, when you think about it, so they're talking about the US, it's true that the Bureau of Labor Statistics has been documenting that in 2021, about 10% of the workers were belonging to a union. So it's kind of weird to have this kind of assumption. Also, Hall and Kruger document that a substantial share of workers actually bargain over wages. That being said, I think that if they had gone through a more traditional route, their mechanism would be preserved in the model. And the reason is the following. So as it is well known also in the search and matching literature, the size of the match surplus influences the reaction of job creation to aggregate fluctuation. Typically, when your surplus is small, you will have a large reaction. When the surplus is big, you would have a slower reaction, a smaller reaction. If you think of lower skilled workers as having a smaller surplus, and you could have like a labor market for low skill, a labor market for high skill, you would naturally obtain in this context that the employment of low skilled worker would be more responsive to aggregate, to aggregate fluctuations as they do in their paper, okay? So this has been confirmed by this paper by Longo and co-authors in a linear model. It's true that in the case of Felipe, he has a nonlinear model. So there are other things that may go in the other direction. For instance, like poorer worker, maybe more attached to the labor force. And in the end, this may dampen job separation. But I'm pretty confident that they would get nice results even in this alternative framework. Another thing you want to do maybe is to introduce capital, okay? So just because Sofia Bauduko is the chair, I brought up this paper, you know? So well, it's not only her. It's also Algan and Rago who published this paper in Review of Economic Dynamics in 2010. So basically, what Sofia Bauduko was doing is like to look at the impact of trend inflation in the context of IRE type of model with capital accumulation. And she was looking at the heterogeneity of the impact. Okay, and she was having a different impact depending on where you are in distribution. So it's true that in the case of Felipe, it's not that he's looking at trade inflation, but you do have higher inflation under your asymmetric rule. Okay. So what she found is that inflation gives incentive to hold real assets. And in the end, the economy will accumulate more capital, something that will happen in Algan and Rago. Okay? And so given that you have more capital, on the one hand, you will have that the return on capital will go down because capital supply goes up. On the other hand, wages would go up because in the model, capital and labor are complements. Okay? Given that poorer workers, basically, their income depends on labor rather than capital, you would get that inflation in this context would favor more poorer agents because they would earn higher labor income as compared to the richer ones who would suffer a lower return. Okay, so I'm pretty confident too that if you had to introduce capital into this into their framework, you would also get something that could help poorer workers like on the other market. That being said, that's what a model says. But it's true that when you think about it, in reality, it's not clear whether poorer workers could face, I would say, a change in financial conditions, would be more would be as adapt as rich agents. So there is like, especially in development, like this huge literature on financial literacy that may imply that poorer agents actually would have a harder time to reoptimize their financial portfolio when you change economic condition. Okay, so this idea has been pushed in a paper by Errusa and Ventura. It's like a paper 20 years ago in the GME, where they show that actually because poor workers basically hold more money, inflation would act as a regressive consumption tax. Okay. On the other hand, you could say that inflation would favor borrowers and would hurt lenders. So given that some of the poor agents, people closer to the constraint maybe, would be borrower, this could also act the other way around. Okay. So I was very interested in this asymmetric rule you showed us. And when I was reading the paper, I had this subjective belief that actually a monetary policy is asymmetric in reality. Okay. like being more aggressive in a recession and not so much in expansion. I must say that that belief is clearly biased by the fact that the underlying shocks are typically asymmetric too. So in a recession, typically it hits harder the economies than the expansion. So I tried to do some Google search and try to find whether people have been documenting that the Taylor rules for, I would say, there is inflation targeting in theory, but maybe in practice they do behave asymmetric. So I found this paper by people at the ECB that were saying that for the Fed, actually they've been behaving kind of asymmetrical, especially in times of financial recession, they would have this asymmetric bias. However, my guess is that, so I cannot really compare the numbers in the paper because it's like Markov switching process, you know, you don't have a coefficient that you compare to your 0.10 that you had in your paper. My guess is that your asymmetry would be stronger than what people have been documented. But that's something that I was thinking about. So finally, I have like some other questions, comments. It would be great to give a bit more information about how the intensive margin and the extensive margin behave in the paper. So especially for the mechanism that is going on. So I don't know whether the volatility of the extensive and distantive margin are in line with the data. That would be great to document that. You were talking about labor earnings inequality. It wasn't clear to me whether it was like in nominal terms, in real terms. If it's a real terms, given you divide by the price, at higher inflation, do you have like mechanically that inequality goes down because you're just increasing the price? I don't know. It would be great to. And then I have like some minor comments about that I can send you about typos and precision. So thank you, Felipe, for the opportunity.
Okay, thank you. So now we have time for questions from the audience. Yes.
So I was just wondering whether the incidence of these separations and things, since you're focusing on the skills acquisition and stuff, whether there might be a way to think about it across the age profile. Across the age profile, yes. So like maybe if you had some form of a perpetual youth model, but then you put in like a drift on your ZT process. That's why I was asking about the ZT process. It might be a way to kind of get at that, so that the incidence across different age groups of skill acquisitions. I mean, everybody seems to be saying that, you know, the downturns hurt young people so much, and it might be a good way to get that.
Thanks very much. This is a very nice paper. I learned a lot, and I thought it was very interesting. I just have I have several comments actually. The Fed did change the language in our long-run statement that we do every January, and we did include this new language, broad-based and inclusive employment. So. I'll just give you my take on that. It's Big Ten language, so you tried to get everybody on the committee to sign on to this, but my take on it was that it was a recognition of how we talk about macroeconomics generally speaking, because usually we look at some social welfare measure or something that tries to take into account everybody in the whole economy. So we were getting criticism from, you know, some quarters that we only care about Wall Street or something like that. So this is a way to say, no, macroeconomics is about everybody in the whole economy. So to me, that's what we were trying to do there. And I would just point out for this paper especially that we did change something else in the statement of long-run goals, which is the word deviations was changed to the word shortfalls. So what this meant was that the deviations language came I believe, from Ben Bernanke, who was doing a kind of standard geeky thing like we would do at a conference like this, where you say, okay, it's deviations from the natural rate of unemployment that we want to minimize. We change that only to shortfalls. So that's where the asymmetry would come in, and it would mean that if unemployment was low, but inflation was also low, we would be less concerned about that situation than we used to be. And this is very tangible because in the 2015-2016 period, when Janet Yellen was chair, the committee worked hard to raise rates during that period, even though inflation was below target, on the grounds that we thought the labor market was too tight and we were going to get inflation in the future. So it was a reaction to that. And so I think the shortfalls is something maybe you should cite here as a motivator. On the labor force participation, I'm not sure I got the whole picture here, but it looked a little exogenous. I've always felt on this issue that participation, if you want to get serious about it, would have home production as part of, at least a simple model of home production as part of the calculation. And then you'd be wondering if you're distorting the home production margin, you're sort of enticing people into the labor market that would really have higher utility from being at home and producing home goods. And so I think I always harp on this in all these conferences because the way policymakers talk about labor force participation and a lot of economists is just that we want everybody in the whole economy to participate, and I don't think we really, that's not really what we want. We want the sort of the optimal allocation of work within the household, something like that. Average inflation targeting was also set up to confront the zero lower bound on the policy rate. I didn't see any discussion here about the zero lower bound, so the idea was to, because of the zero lower bound, you're going to miss your inflation target to the low side when the zero lower bound is a factor, and because of that, you should probably overshoot sometimes. So I think if you want to address this issue, you probably have to bring effective lower bound. Also, I don't know if the simulations that you had ever produced a zero policy rate or not, so that would be something to look at. The inflation tax was discussed here just now. I do think, something like a Rosa Ventura where inflation's a regressive consumption tax, should be in here in order to get a balanced assessment of what's going on. And then finally, do the Phillips curve estimates coming out of this, would they fit the data? This sounds like there's a very strong Phillips curve. In fact, there's a long run Phillips curve that isn't vertical. And so that would be consistent with Okun, who certainly thought there were long run policy trade-offs, but the international evidence, I think, goes the other way, where countries that have run higher inflation don't necessarily have any different or better unemployment experiences than those that have run low inflation policies. And that's why there was so much focus on inflation targeting starting in the 1990s, and you really set an international standard for 2% inflation. So, but this model is certainly one where you can sort of formulate, sort of what was Okun thinking in modern terms, and what would you need to get Okun's ideas. So I think from that perspective, it's very interesting. So thank you.
Presentation, great paper. So I have a few questions. One is technical, which is you have, if I understand correctly, a linear model, but the asymmetric rule is, of course, non-linear. So I understand you guys do a trick. And Gianluca asked me to ask you what's a trick, because that would be very interesting. Second, if I understand correctly, people go to non-participation because they have a utility benefit from it. Is that correct, Felipe? Yeah. I would imagine that utility from non-participation must be huge, because in this model, if I were an agent, I would do anything to work, right? Because I'm if I don't work, I'm getting screwed because I get the drift. And not only I lose productivity, but all the probability go against me as I lose productivity. So, you know, what really makes people go out of the labor force, because it's a terrible thing, a terrible decision to make. And then finally, I mean, going back to what President Buller was asking, it seems to me that one super interesting experiment that you could be doing is the following. The Fed, arguably, or you know, some people argue, did run the economy hot in 2021, partly because whatever possibly inflation persistent was misforecasted, but part of the reason was precisely to get participation. You know, is concerned about the labor market getting participation back up to kind of toward pre-COVID levels. And so you, with your model, can investigate quantitatively that trade-off. Thank you.
I mean, I thought everyone was going to be asking, why is there this long-run trade-off? And I was wondering how, in your analysis, you treat very long-run inflation expectations. Is there an assumption that eventually we're going to go back to some initial level of inflation?
Yeah, so just to follow up on this, the wage setting block seems to be like in the standard New Keynesian model, is that right? And do you have a log linearized wage inflation, New Keynesian wage inflation equation? Around zero inflation, presumably. Okay, so I think that then there is some kind of Lucas critique that one could apply to this, because when we do the log linearization around zero inflation, a nice feature of that is that on average the wage markup that workers experience matches the desired wage markup, the one that they would have in the absence of wage stickiness. If inflation is positive on average, as it is in your case, then the average wage markup is below the desired wage markup. So in a sense, workers are being fooled, like systematically by the policymaker. So one would expect that they would respond to this, you know, by adjusting wages upward. Now, the real wage cannot increase in your model because of your assumptions and so on. So the only way to bring back the wage markup, the average wage markup, to the desired wage markup is to increase unemployment, to reduce employment, and hence to, you know, unfortunately bring back inflation down to zero. So again, it's a possible critique of the approach.
So just want to echo some of the previous questions. It seems that a key part of your story is these heterogeneous job finding and separation rates across the wealth and skill distribution. So it seems that in the model, if I understand correctly, they are exogenous or fairly exogenous. So my question is, do you have, I mean, this is totally fine for the analysis, but do you have a sense of whether it comes from more like the worker side or the employer side? And I would guess that, as Marco was suggesting, the welfare implications might be different.
Honey, thank you very much. Developing what President Bullard said about the U.S., that it already is to a certain extent asymmetric. I think it would be interesting if you could look at that, but also maybe look at other countries to see whether the response is already asymmetric. And then from that, you could also draw from empirical evidence, but also think, you know, whether it should be more asymmetric or whether the job is done and so on. Thanks.
Okay, so I'll not do justice. I want to thank first for the comments, okay? And let me start with our discussant. So Yeah, regarding the wage setting, it's a practical decision. Kind of, I want to keep the model as close as it is to the Hank literature. To the extent of the share of people that are unionized or not, I think that the important thing is, does the union kind of capture the forces for wage adjustment, even for people that are not necessarily unionized? So people kind of don't like to see their real wages decreasing. The driving force through the union would show up there. So I think that is capturing at least some of the forces that are driving the adjustment in wages. I completely agree with your intuition regarding the size of the surplus, that potentially the size of the surplus is small for these low-skilled people. Nakajima does it all the way for different demographic groups. That's exactly what you find for disadvantaged Black, Hispanics, etc. So I completely agree with that. I love that you talk about the capital. So Gianluca and I, we kind of discussed that. We potentially think as an extension. And it's even more important in heterogeneous agent setting by the work of Adrian. I think Ludwig was there as well, I don't remember. But in kind of realizing that the indirect effects of investment are particularly important in a model with heterogeneous agents because of the high MPC, this feeds back to their labor income and kind of activates the Keynesian multiplier. Thank you for the reference on the symmetric rules. We are going to take a look at that, and please send the slides. I want to go over through the other comments, okay? So on the age profile question, that's something that we're thinking. Gianluca has like previous work which has some life cycle dimension. We started with something simpler just because we wanted to add, but I completely agree. And that can even add us to talk about the effects of entering during expansion recessions and the long-lasting effects. James, thanks so much for all the comments. Let me see things that I can address, okay? So the shortfalls, that is kind of also in our motivation. I took it out from the slides because the asymmetric rule enters a little bit late. We should bring those back. I'm sympathetic to the home production argument, and we should probably put a little bit more thought of there. The zero lower bound is also in the back of our minds. So I didn't show you the real rate or the nominal rate. We're clearly hitting the zero lower bound over the Great Recession at least. I'm hoping that we can extend the method to kind of include it and think about it. And it would be nice because, as you can correctly pointed out, the zero lower bound is exactly a force that drives the average inflation bias down, while our asymmetric rule is exactly pushing the other direction. So I think it would be nice to extend our figures on the trade-off exactly along those lines. Marco, so the way that we are doing the technically implementing the symmetric rule is by using monetary policy news shocks, which I learned from these guys. And so they kind of made the argument that you can think of alternative monetary policy rules. Households don't really care of what is the rule that's kind of driving. They only care about the path of the nominal rate, and you can implement different paths of nominal rate by using monetary policy shocks. The only thing about the asymmetry is that instead of solving a linear system, you solve a linear complementary system, where these shocks have to be positive only if they hit the constraint. People don't like to participate because there is a utility cost of being employed. We can check off how big that number is, but there is also a bunch of people just forced out of non-participation through that passive non-participation state. And it's actually like a big fraction in a current calibration. At least there is long-run effects. If we stop shocking the economy, we just revert back to the steady state. So there is no final steady state long persistent effects. It's just that the asymmetry, as long as we are shocking the economy, right, by just making expansions larger and recessions smaller, generates a different average. Thank you very much, Gali, for the comment. I think it's a very nice point. We'll dedicate a little bit more thought to it. I don't have a good answer. And Elisa, thank you as well for the comment. We should think of where that's coming from. I currently don't have a great idea. And Stephanie also thinks we're going to look at the other countries and we use the reference that you made from the symmetry. Thank you very much.